Hiya, Mark.
I'm seeing it. Yes, there you go.
There you go.
There you go.
Mark. Good morning, everybody. Sorry about that. A little boomer accident.
Good morning.
Okay. Welcome back to F.A.C.E, Mark. Always a pleasure to have you here. And, you know, a lot of people are, you know, strongly neutral with what's happening in the dollar lately. And maybe you could give us some clarity. What are we looking at? Is this a new index that I saw a tweet several months ago that you had some type of new index that you were paying attention to with the euro. Do you know what I'm talking about?
Yep, sure, Dale. So what I did about, you know, everybody talks about the dollar index. And as you know, the dollar index, it's tradable, which makes everybody want to use it. But in reality, it doesn't. What does it really mean? You know, the dollar index does not include two of America's two biggest trading partners, China and Mexico. The dollar index is heavily weighted towards Europe. So I thought that for my clients, which are mostly corporations these days, that they needed something more useful than the dollar index. And so I helped, working with Bloomberg, we created a GDP weighted currency basket. Top 12 countries in the world. 6 of them are emerging markets. 6 of them, of course, the majors. And just to put it in perspective, so the US is about 30%. The Eurozone and China are each about 20%. What I wanted to show you today, really, and this might help clarify Steve's point, I think, which was really that right now there might not be a clear trend. What this chart is chart is really what the Federal Reserve looks at. It is a real, meaning it's adjusted for inflation, broad, meaning it includes the US all the US trading partners. So real, broad, trade-weighted measure of the dollar. And this goes back to the breakdown of Bretton Woods in the early 70s. This is really the story, Dale, of your and my careers in the financial markets. Yeah, and what it shows us is that there have been 3 big dollar rallies since the end of Bretton Woods. The first one, the Reagan dollar rally. The second one, the Clinton dollar rally. That's the Clinton tech bubble. And now we've had this Obama/Trump dollar rally. And in my work, I think this third dollar rally is over. And I thought so, though, since really late 2019. And of course, when the pandemic first struck, you can see here the dollar, this broad trade-weighted measure of the dollar made marginal new highs. We saw that, like the euro breaking down. We saw the dollar yen spiking. But I think this is still rolling over. And Steve's point, of course, in the short run, the dollar has been well bid really since January. So for me, this dollar up move is 2 months old plus. It's corrective in nature. It relates to the big sell-off we saw following the election. Well, early November, 2 big things happened, right? The election, but also was the vaccine announcement. So to me, a new world like unfolded in early November. And what we've seen in January, February, and a little bit here in March is just a correction to that big dollar sell-off.
Okay. All right. So with this new index that you've created, are there any emerging markets that really they suffered a lot under a strong dollar regime where there could be outsized moves? I mean, you know, countries like Russia or Brazil or, you know, some of these countries that a strong dollar, because a lot of them have debt denominated in dollars, a weaker dollar is going to be relief for them. I mean, you're already seeing it with money flows into international funds. Are there any plays on probably more speculative currencies in that arena than just the majors that we're focused on here?
Well, I do think that, you know, for a lot of us, it's really that we focus on the majors, maybe a couple of the emerging markets that are liquid and accessible. But I think that, you know, when you look at the how the world is shaping up, so what's happened is we've seen a big jump in rate in U.S. interest rates. And this, as you mentioned, hurts some emerging market countries. Part of the strength, for example, of the Mexican peso, second strongest currency in the second half of last year, up about 15.5% or so. What was driving it was relatively high interest rates compared to most other emerging markets as well as major countries. But since we've got this backing up of U.S. interest rates, those countries that relied on high interest rates to bring in world savings have sort of fallen out of favor. And so when I look at the emerging markets just so far this year, from a big picture, 4 out of the 5 worst performers are in Latin America. This is where you tend to get the high yields, which a lot of those fixed income fund managers like. So Mexico, Brazil, Argentina, Colombia are 4 of the 5 weakest currencies. And so I think that that's an important signal that despite strong U.S. growth, that interest rates sort of trump the growth channel.
Okay, so that too is interesting. With what rates have done, you know, this rate scenario, Mark, you know, there's a lot of company now on the reflation trade and what's happening to yields tripling on the 10-year, et cetera. Do you think that this move in yields is the beginning of something big, or some contrarians, you know, I forgot the guy's name. There still are people. The story changed from last year, everyone talking about negative rates possibly happening even here, to that yields have bottomed and there's only one way for them to go. Is it possible that we still get yields going back towards the lows that we had during the COVID crisis, or that's something that we may not see for generations?
Yeah, Dale, isn't that great? Like, for our careers, say 30 to 40 years, interest rates in the U.S. have been trending lower. Inflation's been trending lower. Yeah. And now a lot of young pups want to say, oh, this is the end of the 40-year downtrend. I wish it was. I'm not convinced it necessarily is, but here's what I think is happening. I think both of your points are right in the fact that we can have negative interest rates, but also higher bond yields. You know, the Federal Reserve and the Treasury, I should say, are still struggling with reducing the Treasury's cash balances. This means fewer T-bill issuance, and this has had an impact, driving some interest rates negative. I know for most of us who are trading our own accounts, the plumbing, the short end of the curve is really dominated by banks, and we tend not to pay much attention to it. But the general collateral repo rate. So if you have a treasury bond, you're at a bank, you have a treasury bond, you want cash for it, so you repo it. You give it away to get the cash, and then you're going to unwind that. Well, those general collateral repo rates have gone negative. So we do have at the very short end of the U.S. curve, part of the plumbing that's behind most of the walls that we, as individual traders, look at. But some of those interest rates at the short end of the curve are negative, and the heaviness won't go away for a couple more months until this adjustment is made. And this all has to do with our dysfunctional fiscal policy. In July, we have the debt ceiling, and part of the agreement is that the Treasury will bring down its cash position back to where it was when they extended the debt ceiling. At the long end of the curve, though, that's really most of us focus on. And here's what I see happening, and this is why I think it's important ahead of tomorrow's FOMC meeting. Ballpark, the U.S. 10-year yield has gone up about 72 basis points since the end of October. That's the election and the vaccine announcement. So the nominal interest rate's gone up 72 basis points. And as you know, the yield has two components. One is the real yield, and the other is a risk premium. Then in the U.S., we just reduce to inflation. So what I do is I look at the increase in the nominal yield, 72 basis points, and I say how much of that increase is due to inflation expectations. And it turns out that the 10-year break even, this is the difference between the conventional bond and the inflation-linked security, that has gone up. That inflation expectation has gone up about 58 basis points, which is to say that the bulk of the increase in yields is due to inflation expectations.
Okay.
And that's not good enough, I think, for me. So I drill a little deeper and I say, well, what's driving inflation expectations? It could be the large fiscal stimulus. It could be the idea that the Fed is printing money, quantitative easing, $120 billion a month, and there's no plans to end it. Which is I sort of like just sort of growing up in the markets that sometimes it's the KISS method. Keep it simple, stupid. So without, as fear of oversimplifying, I think that the bulk of the rise in yields, though, bulk of the rise in yields is due to inflation expectations. The bulk of inflation expectations is due to one thing: higher oil prices. And the higher oil prices have very little to do with Fed monetary policy or the fiscal policy. It has to do with the supply and demand in oil. It has to do with OPEC plus decisions, who surprised a lot of people, including myself last month, when they decided to continue their output restraint. So higher oil prices, I think, are the key variable driving inflation expectations, which are driving U.S. interest rates, which have given the dollar a little bit better of a bid in recent weeks.
Mark, we've had a pretty good move in U.S. dollar yen from 102.5 up towards 109 or so. Do you believe in the correlation of higher U.S. dollar yen is tied to yields rising? And can you explain the move in the yen? Does it have legs, or do you think this is just corrective as well?
Yeah, isn't this a great day to talk about the yen? Today we're going to have the 50 and 200-day moving average cross. And I know some people call it the golden cross. Some people call it the dead man cross, depending on which side you're on. But today's the day where we're crossing there. And it's sort of an exciting technical day. So I do, in my work, I find a very strong correlation right now, and that's not always there, but it is there now, between the U.S. 10-year yield and dollar yen. So, for example, if we think that we're going back to late 2019 like levels, that would put the U.S. 10-year at about 180 basis points. And I think that would put dollar yen a little bit north of 110. Last year, we made a high around 112, 30, 35, something like that. I don't think we get back up there, but I think we could come. I think we do take out that 110 level. That's a sort of an important psychological level. But here, too, I think that the move is sort of long in the tooth. I'm not seeing the divergences that we see in some of the, say, what Steve was pointing out with the some of the equity indexes. But I do think that the technical momentum indicators I use, like the slow stochastic or the MACDs, are very extended, and I'm just waiting for them to give me some sign that they're getting tired.
And anything on the commodity currency front, the Aussie, the Canadian, that's catching your eye? Canada's been very strong, USD/CAD very weak. Is that because oil prices have been strong, or is it economically based at Canada? That their currency has been stronger, really an underperformer. Even when the dollar bounced in the last couple of weeks, USD/CAD continued lower. What do you think is behind that?
Yeah, so of course, a lot of North American corporates have a lot of exposure to Canada. There's a lot of trade between us. So it's one of the things that are always on my radar screen. I find that there's three factors, like variables, if you will, that influence dollar CAD. One is the general risk appetite. I use the S&Ps as a proxy for that. I find the Canadian dollar is among the most sensitive currencies to sell-offs in U.S. stocks. I use oil as a proxy for commodities. And then I also look at the short-term interest rate differential. And here's what I think is happening. You see those Canadian jobs numbers at the end of last week? They were very spectacular. And what this means, I think, is that so it's sort of like we all got hit with this shock at the same time, pandemic. And policies, different countries pursuing different policies. So we're at a point now where we have to think of who's coming out first. Which central banks are going to be the first to pull back on their monetary policies? Norway, who said the central bank meets later this week, is the top candidate, but Canada is a close second. In fact, next month at the Bank of Canada meeting, it seems to me likely that the Bank of Canada gives us some signal that it plans to taper its bond buying. Right now, it's buying about 4 billion Canadian dollars worth of bonds a week. And so I think that we could see Canada beginning to reduce its bond buying. It's still a ways away from a rate hike, but the strength of their labor market is impressive, especially compared to the U.S. So I sort of use this rule of thumb that Canada is about 1/10 the size of the U.S. So when they create 200,000 jobs in a month, that'd be as if the U.S. created 2 million. And I'm looking for a strong jobs number from the U.S. next month, or for this month in March. But Canada's numbers, it just seems to me they're a bit ahead of us on rebuilding the labor market. And I think what this will set the stage for, it's not going to be on anybody's calendars, but as you know, Canada has a minority government, and it typically lasts about 2 years. And I suspect that this could be the year that Prime Minister Trudeau calls for an early election. Maybe it's late Q2, early Q3, on the back of this better performing economy.
Interesting. Look, there anything on Aussie? That Aussie seems to be tied to what's happening with China. The commodity complex really had a nice run before this recent pullback. What do you think, Mark? Aussie, a continuation move to the upside with commodities still acting okay, copper, gold.
I lost you for a second. I think
okay.
that this is the difficulty of working in a third world country, a third world infrastructure here in the U.S.
Yeah, how about that?
Yeah. So looking at the Aussie a little bit closer, I think that Aussie's correcting a little bit. Australia, today's another important day for Australia. Earlier today, the U.S. is saying that it cannot normalize relations with China as long as China is harassing Australia for its foreign policy. Of course, Australia is a key ally of the U.S. It's been punished through a bunch of trade sanctions from China, which is its biggest trading partner. And so I kind of like this background. Also, Australia has taken on a lot of challenges this year, right? Besides antagonizing China, it antagonized Google and Facebook. It struck a deal with them. I think that Australia, interesting country to be watching here. I don't see it as so much tied to China as I do to commodity prices, which of course are related to China, but also Australia is I'd see it as a nice proxy for broadly commodity prices and also interest rates. Amazing story here. They are targeting their 3-year note yield at 10 basis points. And talk now is they're going to extend that for more than another year. And so, because right now they're targeting the April 24 note, they might target the November 24 note. And so Australia is here for a while with soft monetary policy. And I think the strength of the Aussie compared to the other dollar block currencies gives the central bank sort of buys them more time before they have to adjust monetary policy. The other point I'd say about the sort of Anglo-American economies, UK, Canada, Australia, New Zealand, house prices. I think this becomes the next, we already see a rising issue for central banks. It's not the dominant issue, but I see it's a rising issue. Easy money, especially in these types of economies, fuels what could be elevated house prices.
They're certainly elevated here, aren't they, Mark?
Mine is never elevated enough, but I think my neighbor's is. And by what I mean by that, of course, is that more households own. So the IRS says more Americans live in owner-occupied places, apartments, condos, houses, than own equities. And so when I think about the wealth effect broadly in the U.S., of course, income is an important part of that. But out of the assets that we have, I think house prices are more important for long-term wealth in America than the equity market.
Did you ever think that they would surpass the 2008 levels when we were in such a bubble? I mean, I believe in echo bubbles, but they're usually not as dramatic. And I mean, people are in certain areas, especially in California, you put a house on the market, Mark, and they're coming in with offers above the asking price and at times still not getting the house. Do you think what's happening with the mortgage, I forgot what the name of the program is, where you could just, what they've done to assist homeowners, what is that called again, where your mortgage payment is put aside?
Even they defer, they make it to defer the mortgage
Yeah,
payments, interest
yeah, I
payments.
forgot what it's called, but anyway, that's going to end, I believe, in October. Do you think that there's some type of perhaps some mini supply issue with people that have not been able to pay their mortgage for almost a year, are not going to be able to come up, or they are the banks and Biden just going to have them tack that onto the end of the loan where it won't be as deleterious?
Yeah, this is a real problem, Dale, for me in the U.S. I'd say that to me, in addition to the climate change issues, what concerns me is the disparity of wealth and income and really power, not just in the U.S., but really major countries and many emerging markets. And so I think that what's happening is that even though, we saw these figures last week, household net worth in the U.S. jumped. Where the U.S. as a whole is wealthier than before the pandemic. However, the way it's distributed is probably less fair. And so what I think is going to happen, a lot of us are looking at these savings rates,
Yeah,
and see that American households have what some people call excessive savings. And I think a good chunk of that is going to end up to be used for exactly what you're saying. The the forbearance granted to
that's it.
mortgage holders, uh,
Forbearance.
forbearance, yeah, it was granted to mortgage, to borrowers, is it doesn't really forgive them of the loan. It doesn't really say they don't have to pay it. They just buy some time, and they're still accumulating the interest on that unpaid part. And so it does seem to me that some of this high savings rate that many people think is going to fuel consumption is really going to fuel debt servicing. I know a lot of people
Interesting.
who are sitting with lots of cash, who aren't going shopping, who aren't buying things because they know they're going to have to pay their landlord. And in the meanwhile, they're building up their savings, improving their credit ratings. But this is a concern, and this is part of this fiscal cliffs that we should be expecting. You know,
Okay.
uh, and I think that fiscal cliff, even the unemployment compensation that was in this new stimulus measure, it only extends till September. And what concerns me is these date specific as opposed to condition specific. If it would be
Great point.
unemployment compensation could be extended until unemployment is below 5%, or that this forbearance on paying mortgages can be done until the unemployment is below 6%, or come up with some economic number as opposed to some date. Otherwise, we're going to have these fiscal cliffs, and that's what we're going to be trading off of.
Interesting. All right, so something to look forward to in the fall. Before I let you go, Mark, I have to get a couple of comments. First of all, crypto. Just a comment.
Crypto. I think that crypto is money in the same way my wife is Catholic. Self-identification.
Okay.
If the
Right.
Bitcoin would have called, if they would have said, you get a token for solving this energy-intensive computer problem, and how much is it worth? I think that if it wasn't being called coin, if it wasn't being called money, it would clarify what's really going on here.
Okay. And the other thing is,
somebody
go
would
ahead,
say
Steve.
that I love Mark because he's like an echo chamber to me. But really, I mean, I wish more people were logical enough to we wouldn't have this kind of ridiculous markets.
All right. I want to wrap it with this, Mark. You and I and Steve, maybe half as long, have been in this business a long time. We were always trained, and Blake was talking about it today, on how when the retail guy got involved in the market, it was pretty close over the shoe shine boy, the cab driver, giving you stock tips. To me, seeing little guys in large groups come together and squeeze hedge funds is, I believe, a new paradigm, where the retail trader on his own might be meat for the pro to gobble up, but in large groups, it seems that they have more power than I ever thought that they could. Do you think it was them, or it was big hedge funds using these communities, as a cover for what they were doing?
Yeah, I was fascinated by this. Of course, I don't trade GameStop.
Yeah, I
I'm
know.
not really involved in that space, but I do marvel at this because before we had corporations, there were all kinds of attempts for capital to come together, pools, trusts. And the reason that these broke down was because the agreements cannot be enforced. And so it's one thing to have this sort of, I think that the GameStop probably a one-off, but because here's really the issue is it might be easier to get people to buy, but how do you organize the selling? And the incentives is for people to defect early, so they're not the last one holding the bag or stock in this case. So I'm suspicious that this can really be duplicated in a planned, organized fashion. But of course, the democratization of the capital markets poses a challenge to the big pools of capital.
Yeah. And I'm going to ask this, Steve Volge has, brought up many times that Russia's debt to GDP ratio is really in great shape compared to, our more mature countries, developed countries. You have a view on Russia? The ruble did start to strengthen in the last year or so. You think the ruble might be a place to take a long shot spec on ruble appreciation?
I do. I mean, so from a big macro point of view, you've got a country that has dollar receivables, and so their dollar bonds look attractive to me. The ruble looks attractive to me as long as you're bullish oil. I sort of think about the ruble as a proxy for oil. But in general, for many of us who are concerned about, aiding the enemy, so we don't want to buy so much Chinese stocks or Chinese bonds, the government tells us, because it's funding the People's Liberation Army, the Chinese military. And Russia is not a good actor. And I know that sometimes we trade, we want to separate our politics. But I think that Russia might be an attractive for the short run, but is the money really worth it? So bullish on oil. Russia's balance sheet looks attractive. High yields look attractive. But for me, I'd rather take money from another country than Russia.
Okay, so that goes back to a lot of people that want to buy EVs and invest and be socially responsible in equities. I guess you could be socially responsible in foreign exchange as well. Great way to end it, Mark. Go ahead.
Great. No, so thank you very much for your time. I always enjoy chatting with you, Dale and Steve.
Yeah, so it was great having you, Mark, and we're not going to let as much time pass. Go ahead, Steve.
No, I mean, thank you, Mark, for being here.
Okay.
We always enjoy it.
Yeah. Thank you so much, Mark. Good hunting, and we're going to have you back real soon. Okay, this summer sound good to you?
Great.
All right.
Luck to everybody.
All right. Good luck. Good hunting. Congratulations on developing a new index that gives your customers and the rest of the world a better understanding of what's happening with an index that is broader and gives you a more definitive picture of the dollar. Very creative work. Congratulations, Mark.
Thank you. Good luck.
All right. So that's a wrap, everyone, for Turnaround Tuesday. And we'll see you tomorrow for Fed Day. Good hunting the rest of the day. You could join the Morning Edge in 15 minutes. Don't just count your rubles or your yen. Count your blessings, and we'll see you all tomorrow. Adios.
Bye-bye.
Thanks again, Mark, and thank you, Steve Volge. Adios.